Our next guest believes the road ahead for rates could determine the market's direction in the second half. Let's bring in Chris Verrone, head of technical and macro strategy at Strategas. Chris, good to see you. I know you've been focused on yields for a while. They've now, at this point, sort of bumped up against the ceiling, maybe gone through it. What are the implications, and where do you figure they head?
I think it's a really big deal. I mean, we've essentially been chopping in yield since the equity market bottomed in October. Let's call it from 390 on the high side to 350 on the low side. We just ran out of real estate on the chart. And now we've decisively, I think today, pushed through some of these big levels. So in terms of determining what this may mean for stocks the back half of the year, I certainly want to sleep on it. I do think there's an irony. It's happening in a week where no one's at their desk, too, right? Always big stuff happens. We went back and we looked. When you've had really strong first halves in stocks, the years that come to mind are 95, 98, even 87. Yep. If you look at the second half of the year, rates continued to fall in 95 and 98, and they went the other way in 87. Yeah. So just looking at that as some type of a roadmap, I do think, you start pushing 420, 430 on yields, which was the high back from October, you got to begin to wonder that start to put some pressure on stocks. Yeah, and just to spell it out, I mean, 95 was this, continued melt up in stocks. 87, of course, we know what happened when rates got too high. We had the crash. So you have real yields also going higher. So a lot of these things that feel like they might be pinching around the edges. In terms of the types of stocks that have worked and not worked, does it change the equation? You know what's interesting? Today's the first day in a few weeks where you have yields up and defensive showing some signs of life. Yields up doesn't particularly worry me when pro-cyclical groups are leading, and that's largely been the case over the last several months. Today's the first day of a little hint of a change there. I always want to be on guard when you have rates up, which should mean stronger economy, being accompanied with defensive groups, utilities or staples or healthcare. That's not the best mix. It's one day of it, but I think it bears watching going forward. It reminds me a little bit of the summer, fall of 2018, where rates were running away and leadership started to skew more defensive. That's a message that, hey, maybe the market's a little uncomfortable with rates here. So we'll watch that. It's only been one day. I think on balance, the leadership of this market is still largely driven pro-cyclical, whether it's industrials or discretionary, but we got to just put that on a little bit of watch here. And then in terms of outside of those areas of leadership, in terms of the broader FANG world, it seemed like it was sort of underbelieved and underowned 6 months ago. Now, after piling on all this market value, where does it leave us? Yeah, I'd watch a couple things here. I'd say, number one, you mentioned real yields. There's been a pretty good relationship between real yields and growth value. It broke down a little bit over the last several months. I just wonder, with this breakout in real yields up through 165 on real 10s, does the growth value relationship start to stall, which it actually has quietly over the last 2 weeks. I mean, look at Microsoft really hasn't participated the last 2 weeks. Google hasn't participated the last 2 weeks. I just think that bears some watching moving forward. The trends are still up. Sure. They've ridden the 50-day moving average all year. I'd make that the starting point. Do any of these names start to violate the 50-day? It's been support all year. I think it's a big litmus test going forward.